Superannuation will be the most tax optimal place to invest in retirement, as you can establish an account-based pension where you have up to $1.9 million of funds invested in a tax-free environment and draw down from these funds. All the income received from an account-based pension is also received tax-free. When we explore putting together an investment strategy, it's important to balance the risks of how much income you'll need to live and to fund any lifestyle expenses over the course of your lifetime, while also mitigating the risk of a market downturn. Crafting an investment strategy is prudent to have 3 buckets of funds available. The first bucket contains at least 2 years of income required to fund your living expenses. This is typically 2 years of cash available to guarantee your standard of living. We also advise in doing so to mitigate what we call sequencing risk. This is where the timing of your withdrawals in a market downturn can damage your over returns, particularly when it's at the start of your retirement. The table below shows the impact of drawdowns in a market downturn compared to an upturn. In the second bucket, depending on your risk tolerance, it's also prudent to maintain some form of fixed income securities such as government bonds, hybrid securities, or private credit in order to maintain a return higher than the cash to offset any medium-term risks of inflation. These types of securities focus on income and capital preservation. Lastly, the third bucket is a bucket consisting of investments held in equities or other growth assets. While these investments may be more volatile in the short term, over the long terms, shares become a lot more predictable. The only guarantee with investing is the cost of doing nothing, and over the long term, inflation eroding your capital and purchasing power. It's important to have funds invested in equities to address the longevity risk of your portfolio and ensure that your funds truly go the distance.